Hey traders, this is Blake Morrow with Forex Analytics, and you're listening to the week ahead video for May 12th, 2024. I'd like to first off say Happy Mother's Day to all the moms listening to this show. In the United States, we celebrate Mother's Day, and it's a very special day on May 12th every year. And if you're a mom, I just want to say thank you. We all appreciate you and for what you do for all of us. So thank you and happy Mother's Day. And for those of you men that are watching this, if you haven't bought your wife a Mother's Day card or flowers or given her a big hug and a big kiss, your mom, your wife, do so. They'll appreciate it. All right, let's get on with the week ahead video. Okay, so this week is going to be a busy week. It's CPI week. The reason why it's going to be so busy, if you see the compressed nature of the markets, how they just kind of went sideways all week, you know it's going to be a busy week in the markets. So therefore, get ready for some volatility. Also, last week was a fairly busy week in the markets as well. We had, several central bank meetings central banks meet. We had the Bank of England, we had the RBA, we had Banxico, we had the RIX Bank. They cut their rates by 25 basis points. Brazil, slowed the pace of their easing this last week. So, central banks were active, and but the markets didn't really take notice until the FX market specifically really took notice of the weekly jobless claims, and then also the University of Michigan consumer sentiment. So what that triggers a couple of things for me, which we'll talk about as we go through this calendar on what we're going to be expecting this week. I do want to remind you that as you watch this video, it's a fairly long video. They are chaptered. So just if you've watched this video a couple hours after it's been released on YouTube, more than likely there are chapters. And so you can go through, just remember at the very end, I also go through the setups from last week, how they did. And then I talk about the trade setups for this week. And so hopefully you guys are really appreciating that delivery method that I've been doing for the last couple of months. So let's get into it. Let's talk about everything. You know what? I also have to say, a really nice thing happened to me just actually about 30 minutes ago. It's Saturday. I had to run around, do a lot of things since 0:30 this morning. So I'm filming a little bit later than I normally film this video. And I had a coaching session come through, which I'm meeting her on Monday. And so Tiffany, if you're watching this, I just want to say, looking forward to meeting you. She said she met me years ago. I'm talking like 15 years ago. She met me originally when I was at the Wise Trade Group and at MB Trading. And she's getting back into trading, and she, wanted an hour of my time. And so she's going to be joining me in the coaching session. So if you ever want to see what we do where we can work one-on-one, she actually wants me to help her build a trading plan fit to her personal, strategy and time she can allocate. I'm going to do that. So it's going to be really neat meeting you on Monday, Tiffany, if you're listening in. For the rest of you, just remember, we do have coaches that you can book. You can see what times they're available. All of our prices might vary just a little bit, so check it out when you get a chance. All right. And actually, I just did a session on Friday with a gentleman out of the Netherlands. It was a really wonderful meeting. It was nice meeting you, Francois. All right, let's go into, and I know you're watching the video, so nice to meet you, actually, on Friday. Let's talk about things that are happening this week. I'm going to go ahead and put myself off of the video so you don't have to see me specifically. But remember, you can go through Forex Analytics. You can follow along in the live charts. You can follow along in some of the basic technical analysis. But as I'm speaking, some of it's being updated by our team members throughout the course. It might actually they're being updated right now as I'm speaking. But we also have a calendar over off to the right hand side where you can follow along as well. I'm going to be going to our charts. As a matter of fact, let me go ahead and pull up the charts that I normally use here for the week ahead video. These are the ones that come untouched. And let's start off with Monday. So, well, actually, you know what? We're going to have to start off on Sunday. We're going to have to start off with Sunday because it's New Zealand inflation expectations. Now, the New Zealand dollar has done something a little unique. And I want to talk about, this pivot, really key level of resistance. And I'm going to have to do a little bit of work with you because it's been a while since I've done analysis with you on this particular pair on the show. So I'm going to do a little bit of drawing. So first and foremost, I want to point out that we actually created a higher low. So I think you all can visually see that, and I'm being Mr. Captain Obvious right now, but that's okay. I want to point out a couple other things about the Kiwi. If you haven't seen me on the trade-off show, you may not know this, so I'm going to go ahead and draw it out for you. Okay, there's one trend line, and if you're following me, you're probably thinking exactly what I'm going to be doing right now is I'm going to be drawing a descending channel. Do you see that, right? Okay. What else do you see here? Well, I see right now what looks to be, in my opinion, a flag, pennant, consolidation before a rally. Now I'm going to zoom in really fast with the Kiwi, and I'm going to do a couple of things here. So you'll notice that the pullback has been limited to a very, very shallow 38% retracement. All right. So therefore, that means it's got a lot of potential as a bull flag pattern because it's such a shallow retracement. Now we have a couple of big things that are happening. This week, obviously we have US CPI, US PPI, which I'll talk about as we go through the calendar here. But we have New Zealand inflation expectations on Sunday. So if those inflation expectations come in hot, that means the Kiwi has a good chance of breaking out. Now, why is this breakout going to be important? Because what you'll notice is you have this descending trend line. You also have this 200 DMA. Do you see it? It's in red. That's the 200 DMA. So if we break that, then you're talking about a potential move up to 61.65. And we haven't even talked about what happens if US inflation comes in weak. Because if that happens, the New Zealand dollar could really, really pole vault higher. So just something that I think you should be paying attention to. Now you'll notice that actually the pop-up didn't come on because I actually turned them off to film this video. But what I just heard is we might have had some updates, and not yet. I thought it was maybe an update, but it wasn't. Never mind. It was something else. It was another notification that came on. All right, moving right along. Tuesday. I'm sorry. Monday. It's kind of a dead day. Matter of fact, let me just say this. The first couple of days of the week, we're probably going to be seeing some position squaring. So in other words, some consolidation, maybe a little back and forth, but some position squaring ahead of producer prices, which come in on Tuesday, and consumer prices, which comes on Wednesday. So with that being said, Monday is kind of a dead day. There's not a lot of data coming out. There's a little bit of Fed speak, but not a lot of data. So with that being said, really it takes us into Tuesday, where we have the UK claimant count change. Now, what you'll notice here, notice how the sterling is really respecting, and let me go ahead and delete this and let me take me off here. You notice how we're respecting this descending channel. Yeah, we probed above it and got maybe a little false breakout. I would say maybe the 50 DMA is also holding. The underside of that channel is holding. But what that also means is this is still valid for a potential rally. What I would probably be looking for here, especially if the UK jobs data is good, then I'd be looking for, and especially you have average hourly earnings, let's say that comes in a little hotter than expected, the cable could indeed rally. Notice how we held the 618 retracement. We're trying to probe channel resistance. If it breaks, it's going to give us some upside. The flip side to that is if the data comes in worse than expected, you probably know where your risk is if you want to short. Like if you want to short, you're like, okay, well, I just don't want to see it rally above 126. So don't matter how you want to play the sterling, and some of you may be, pound bulls, some of you may be pound bears, but I think we're at a very pivotal area regardless. Okay, moving right along. In the US, we have producer prices. Then obviously on Wednesday, we have consumer prices. Now, I do want to talk a little bit about the dollar index because as you can see here, the dollar index it's trying to play out a bearish pennant right now. The flag sticks a little bit, the flag is a little bit deeper than I typically like, but that doesn't really matter yet. Well, it does matter, but let me tell you why it doesn't matter as much to me right at this moment in time. I'm going to zoom in and let's clean up this chart a little bit. What you're going to notice here, and let me grab it for you. Do you see this? High to low. Notice how we stopped right at the 618 retracement. You guys see that? We stopped right at the 618 retracement. As a Fibonacci trader, somebody that loves fib levels, that's really important. So now what you're seeing in the dollar index is it will play better, in my opinion, to a weaker producer prices and a weaker CPI this week. Now let me stop here and say and talk to you guys about that for a second. My opinion is the dollar is going to play better on any miss of inflation this week. That means we're going to get a bigger reaction to the downside in the dollar based on if we get weaker data than expected, not better data than expected or hotter data than expected. The reason why I say that is because if you look at what the G20 has reported over the last month, all other countries, giving you a number, roughly about 85% of all inflationary data that came out last month came in hot. It doesn't matter if you're talking, Germany to US to Canada to, all the G20 countries. I'd say if I had to throw a number on it, 85% roughly, that data came in better than expected. Why is that a big deal this next week? Because naturally, most people think that inflation is hot, it's running hot, and it's probably set to continue. So that means that people are probably going to be more positioned for a hotter data for the CPI and producer prices. So if it comes in weaker than expected, I think you're going to get a bigger downside response in the dollar. Given what I just showed you technically, how we respected the 618 retracement, that is very important in my opinion, because while it's below 105.75 or 105.73 in this case, but I like to round things up or down a couple pennies, a couple pips, that means while we're below 105.75, you've got to be leaning towards the short side of the dollar. Now, obviously, if inflation comes in strong, there's a good chance we can break above that. And then if we break above that, it turns very bullish. Well, at least back up towards key resistance that you see up here. Okay. So anyway, that's producer prices. Also, I need to mention on Tuesday, Powell is speaking in the Netherlands at the Foreign Bankers Association in Amsterdam. So there are supposed to be audience questions. That is expected. So that means we could have a monkey wrench thrown our way, sometime on Tuesday, before the CPI. All right, but before we even get to CPI on Tuesday night, we have Aussie wage price index. Let's take a look at the Aussie dollar, because the Aussie dollar following the RBA, I'll tell you what, the RBA, they're not super dovish. They're not. I don't think so. And if you look at the Aussie, what we're doing is we are, curling up and consolidating up against that resistance. Now, could the Aussie dollar break lower from here? Sure. Could it break higher from here? Absolutely. Matter of fact, I believe, and let's delete this for a second, and I'm going to show you something. If you listen to the F.A.C.E show, or the Morning Edge, or the Daily Roundup, those are some of the private shows that I do every day, then these are our free shows. You got the Flow show that's in European hours. So if you don't listen to Ryan Littlestone and K-Man, listen to him on the Flow show every morning. It's free. Then we have the F.A.C.E show, which you're going to hear myself and other team members, right? Listen to that. It's free as well. Well, if you've been listening to those shows every day, then you know this. The Aussie dollar is struggling because it's up at a 618 retracement. It is? Oh, it is. Oh, it is. So what does that mean? Well, above 66.80, it turns very bullish, right? Now, notice how we're wedged right up against there. You could trade this either way, but you have this Aussie wage price index that's coming in Tuesday night. I say it's Tuesday night. It's actually Wednesday morning in Australia. Tuesday night for me and any other North American out there. So just keep in mind that Aussie data, it's set up. Okay. Wednesday, we have CPI, as we talked about. We also have retail sales and Empire State manufacturing data. That's also coming out. I want to talk a little bit about not so much the dollar. I want to talk a little bit about yields, because looks like yields could come down. Now notice, and I'm going to go ahead and move this fib. So there's your high, there's your low, right? You'll notice right here by the green line that we have already drawn out here. Now, this is one of those universal charts that I'm using not only for this show, but I use throughout the course of the week. But what you'll notice is this is a 38% retracement. That's also a breakout point, right? What that means is if yields do come down and they break through that support, or you can say, all right, well, if they break down through the 200 DMA, it's going to be quite bearish. So keep an eye on yields because, between CPI, well, producer prices the day before, CPI, retail sales, Empire State Manufacturing, if data starts showing signs of weakness, bonds will rally, yields should come down. And if yields come down, the dollar should come down. So keep that in mind when we're looking at CPI, retail sales, Empire State Manufacturing. All right, now let's continue on with Wednesday night. We have, well, it's Thursday morning in Japan. We have Japan's GDP. Now, I remember, I'm old enough to remember. I love it when people say that. Let me just say it this way. If you've been trading the FX market for over 20 years, or even over 10 years, or even over 2 years, what you've probably realized is the yen doesn't move on Japanese data until the last couple of years. Why is that? Because for once, and for 20 some odd years, finally Japan is moving interest rates based on inflation, growth. Data is going to start to matter. I started my FX trading career in 2001. I started trading in 1996. So when I started trading in 2001, FX predominantly, that's when us US Americans could start trading the currency market as a retail trader. And for all the following years and years and years and years, Japan never moved on data, but it is now. And not as extensively as you would expect, but it's happening. Why? Because interest rates are now moving finally. When interest rates are starting to move, they're going to move up and down, and expectations will move up and down based on economic data. So, Japanese GDP Thursday could be a market mover, may not be a market mover, but what I'm going to tell you this much is the Bank of Japan and Ministry of Finance are really struggling keeping the yen strong. All they've done right now is slowed down the trajectory of the dollar-yen rally. That's all they've done. So it seems like every technical level is just more of a speed bump more than anything. So we have 50% retracement right here at 156.13. Beyond that is the 618 retracement at 157.14. Those are going to be key resistance levels moving up to this week. I'll just do it like this, right? But what I'd rather do, just to make sure I'm clear here, I'd rather be buying dips to 152 again, because we all know if it breaks 152, it's going to break down. We all know if it breaks the 50 DMA, the risk is going to be that it moves down. So if we can buy it down here, down here at the 50 DMA, that I'd rather do. Or be a seller up here at the 618 retracement. All right, Wednesday night or Thursday morning in Australia, we have Aussie employment. I already talked about the Aussie dollar. You know how important that's going to be. Thursday, we have the Norwegian GDP. Now, speaking of these coaching sessions, I was talking to a gentleman. I'm only going to give you first names, but I was talking to the gentleman in the Netherlands on Friday. His name is Francois. When I was talking to him, I asked him, about, does he watch the shows? And he's like, yeah, I watch your week ahead videos and I watch the F.A.C.E shows and blah, blah, blah. And we started talking about the US dollar and Norwegian krona because it's been such a strong focus of mine over the course of the last couple of weeks here on the show. Well, we have Norway's GDP, and what you're going to notice here, and if you haven't seen it already, we're getting real close to what I would consider very key support for the US dollar and Norwegian krona. So if you go from all the way down here to this low to high, you see it's in between fibs. But if you go from this spike low, the last time we made a lower low, which was right there, we're at a 38% retracement. What that tells me is a break below 10.80 or 1080 would be bearish if this happens. Okay. Again, we have Norwegian GDP on Thursday. Thursday, also one of the things that we have, which now we have to pay attention to, is unemployment claims. If you guys didn't see it, the unemployment claims here in the U.S., let's go over to the calendar. Let's go to Thursday. What you saw is a huge jump from expectations. So here is the unemployment claims right there. Initial jobless claims, you can see it. History, show more, show more, show me more. Hey, show me some more. All right, there we go. So actually, we even need to see more than that. So you have to go back to the summer of 2023, and you'll see it's been a while since we've seen data, creep up into the levels that we're at right now. It's been a while since summer of 2023. So the reason why that's so important is because we're starting to see a tick up higher, and the market actually reacted. So if this data stays high or ticks higher, meaning let's say we get 240,000 new or initial jobless claims, or 250,000, the market is going to react quite aggressively. Now, all of us that live in the real world, we hope that that doesn't happen, but it is now entirely possible. So just keep that in mind. Like I said, on Thursday, we have the Philly Fed. Thursday night, we have China industrial production and retail sales. On Friday, very minor final Eurozone GDP data, but we should take a look at the euro anyway, because I think the euro is one of those main staples that we need to pay attention to. And guess what? My analysis hasn't changed from last week. Just move this down. But do you see what's holding us up? The 200 DMA and a descending trend line. So what's that tell you? Well, if it breaks higher above 108, that's going to be pretty bullish. On Friday, I think we got to 107.90. We got as high as 107.90 and 0.2 of a pip. So a break above that high from Thursday or Friday, or a break of the 200 DMA, that's going to be pretty bullish. Something that we need to keep in mind. All right, let's talk about some other markets that I think we need to pay really close attention to. Let's talk a little bit about gold. If you're discussing gold, gold looks like we're trying to make another breakout. So we have that pennant. We drew that last week. Now that pennant's trying to play out. What's most important about this pennant is it goes beyond this channel that we have drawn. So let's talk about that. If gold plays out where it should, that means it's going to take us probably to about 2570, right? So we had this bullish pennant from last week. You can see RSI is starting to tick higher, and we're getting close to all-time highs on gold. It still looks bullish. Copper, check this out. I want to show you guys. Remember, we've been talking about a Gartley pattern in copper, right? Notice how we took out those highs. That's scary if you're bearish. But one of the reasons why I'm fairly constructive on the Aussie right now is because look at copper. Well, look at stocks, but look at copper. Copper and the Aussie dollar tend to have fairly close relationships as far as a correlation. It's pretty positive. So as copper breaks higher, there's a good risk that the Aussie could break higher. All right, continuing on, crude. I'm going to be the first one to admit I have no idea what crude's doing. It's like I'll look at it one time in the day. I'm like, oh my gosh, it looks like it's going to fall, and then it turns around and rallies to highs. As soon as I think it. But I will show you this. Okay. We are now holding below a rising trend line, and we're holding below the 200 DMA. So I'm just going to go out on a limb here and say while we're below the 200 DMA, the risk looks like it could move lower. Now, if you want to find out what you want to ask, what like a possible tailwind to the stock market would be that if we see crude come down, that could actually help stocks continue to move higher. People would think that could keep a lid on inflation. Therefore, the Fed would not have to raise rates. They'd be more apt to cut rates. Okay, so I did talk a little bit about the bond market already and the ZNs. And at this point in time, I'd like to introduce, for those of you that don't know him, I'm going to introduce you to Nick, Grasshopper Nick, from Trading Analytics. He's actually going to take a few minutes, and he's going to go through some of the best indexes, Mag 7 stocks, some of the equities that you need to be looking at. So here's Nick. Enjoy your time with him. I'll see you in a few minutes.
Hey Blake, thanks so much for having me. It's Nick Groves here with Trading Analytics, and today we're going to walk through the equity markets really quickly. So I have the S&P futures chart in front of me. A couple things to note. One, we came up to channel resistance, and two, we are also up at the 786 retracement. We did have a bit of a throwover. However, I wouldn't get too excited because this market is very much so at risk to get right back up towards all-time highs. I mean, you can note that we're 1.8% away from the all-time highs. I think on the cash, you're looking less than 1%. So things could get interesting very quickly, especially given how low this VIX is. This VIX is just constantly on the floor. So that's something to note. It is below 13. Just the other month we were at 20, so it's been quite a decline down, and that could give a little bit of a boost to the equities. Now, this is where the S&P is shown, and I would be looking for a move below 52.34 or so in ES to actually come back and retest 5200 ES. Now, the diff on this between the futures and cash is about 25 points, so just factor that in how you will. As far as the NASDAQ goes, the NASDAQ looking a little bit similar in the sense where it also tagged just near at 786. It did close right on resistance, which I found quite interesting. But this trendline resistance is held since March. So we're going to have to see, will it get back and actually close below? Because if it does and it gets back below 18,100 or so, I believe we're going to revisit the 17,900 level. As far as the Dow goes, it was the best performing this week, closing up 2%. It also came close to the 786. So you're seeing some pretty solid extensions from this correction lows that we saw. Will it be time to take a breather? We'll probably find out next week after CPI, but I would not get bearish to Dow until we actually get back below 39,350 or so. We're going to need a daily close below there. Until then, I imagine dips do get bought. Now, I also want to point out the Mag 7, and I'm going to point out probably just two of them. I'll give you a bull one and a bear one. So as far as the bull, Microsoft looks actually pretty constructive. It's in this ascending channel and a break of 415, and I imagine that we actually end up back near 420 or so, 419. Just looking left, you'll see some support here throughout March and April. So there, and then also the 786 at 421 if we decide to extend up higher. Now, if this breaks, I imagine we actually do come back near the 400 level. Now, for the bear case, let's take a look at Tesla. So Tesla's not looking all that great. The 172 level was a very heavily traded zone for Tesla, and it really needed to hold that, and it didn't. So, and also on the bigger picture here, from the highs to the lows here, we came up towards the 50% retracement. After that massive, I want to say it was like a 38% pop up here. I think some people that had been holding long in Tesla finally decided to get out, and now it's weakening even further. If we begin to push lower still, I imagine somewhere around 160 will be support for Tesla, but until then, it's bearish. And I have one more thing I'm going to leave you guys with, and it's actually going to be a ratio. So I love to look at a few ratios. I look at the NASDAQ to S&P ratio, I look at the XLE to S&P ratio, and I also look at the S&P to gold ratio, if I could just find it on my chart. There it is, I think. So this chart helped me out a lot during the first correction. Taking a look at it, it started to, let me get to a 4-hour chart for us. It actually started to turn before the overall S&P turned. So let me go ahead and overlay S&P here. So you'll note and I've been drawing a little bit. You'll have to excuse me, but you'll note that these do run in tandem for the most part, and you'll note that it started to fall before equities actually decided to fall. Decided to start recovering, and equities have now recovered. Now this ratio is actually turning back down. It did actually reject at the 38.2 from the highs to the lows. Now we're gonna have to see how this plays out. Will it join the trend again and give us a little bit of a signal? That's the one thing I will leave you with. And if you want more, we're going to be posting on Twitter at Trading Analytics. And with that, I hope you all enjoy your weekend. And thanks again, Blake. Oh, one last thing. We're pointing out a lot of different things here on Trading Analytics, and we're looking at a bunch of different tickers. If any of you have an idea of what you'd like to take a look at, just comment down in the section below. Maybe leave your Twitter handle, and I'll give you a chart. So I'll pick one of you. So thanks so much, Blake, and you guys have a great weekend.
All right. I hope you enjoyed your time with Nick. Thank you, Nick, for providing us some analysis and insights to what you're seeing and how you're looking at things. Nick is a great follow. Make sure you follow him in his YouTube channel. You can actually get to that link just below, and you can also follow him on Twitter on Trading Analytics with an X down below as well. A link to his Twitter profile is down there. All right, I do want to talk a little bit. I know Nick talked about the equity markets. I will actually go through the S&P really fast, how I'm seeing it. Let me go over to the S&P, and we're going to review this here in a second. But notice how the S&P is basically up at the 88% retracement. This is basically the last level of defense for the S&P. You know, you can see momentum starting to slow this week as we're heading back up towards all-time highs. But I'll tell you, the one thing that's going to put us in a new all-time highs is a weaker inflation print, both producer prices and CPI. That could put the stock market at all-time highs again. Also, I need to mention that Bitcoin, got to watch it though. Bitcoin, we still have that bull flag pattern, right? But we are, drifting lower in the flag pattern. So as long as we stay above 58,000, the risk is still for a breakout to the upside, but I'm a little worried that it's stalling at this point. All right, this is the time in the video where we're going to cover the trade setups from last week, and then I'm going to give you the top 3 for this week. So the first one that we talked about last week is the US dollar Norwegian krona, which we already discussed a bit ago. Short while it's below 11. Well, we got a bounce early in the week, and we got to 1095, 1096, and we fell to the lows again by the end of the week. I count that as a win, right? If it got anywhere close towards 11, which it did, and you shorted it, you're probably doing fairly well. For those of us that have been hanging in to our US dollar Norwegian krona shorts, congratulations, you're doing well with that one too. All right, the next setup was US dollar Japanese yen short on a sustained break of 152. Well, that never happened. We never got back below or even close. We never even went down this week. So therefore, it negates. It didn't matter. So, okay. Win one, negated one, and then S&P short at 5,200. Now, this is going to really depend on how you tried to play it, okay? Because I want to show you something. If you go back to last week, you go back to Monday. This is us Monday. We basically hit 5,200 on the S&P. If you shorted within a couple of S&P points of the 5,200, you did well. But if you held on, then you lost money. So the fact of the matter is it held 152. If you were listening to our free shows at the end of the week, you would have heard that I was clearly looking for higher prices. So, do you count that as a win or a loss? Well, that's up to you. Maybe we can just call it scratch, right? So you won one, other one invalidated because it just never even happened. And your third one, we just call it a scratch. Not bad. All right. Now, here's your top 3, or my top 3 trade setups of this week. So the first one is going to be the euro yen. Now, what am I going to do with the euro yen? Well, let me pull that chart up for you. So, why am I so excited about the euro yen? I don't know, just say I'm really never necessarily excited about the euro yen at this moment, but I will be excited about the euro yen. Remember, this is a setup that never happened, right? Just kind of like the short dollar yen on a sustained break of 152. That didn't happen. Euro yen, I think we need to buy dips to 165.50. Why? Well, if you just keep this rising trend line going higher, it's going to take us all the way to, by the time we get back down here, it's going to be about 165.50. So what I'm trying to say is I would like to buy the US dollar or euro yen on any dip like that down to 165.50. All right. But that may not happen, but that's like a setup that I like. Kiwi, buy the break of the 200 DMA. So if the New Zealand dollar breaks above the 200 DMA, which is basically, we already talked about it, which is basically Thursday and Friday's highs, we break above that level, it's bullish. Last but not least, DAX. I'd like to see a counter trend short at 19,200. Now, the DAX, let me show you the chart. And let me go ahead and add that. So let's do it this way. DAX. And we're going to add this to, we will just add, oh, is it already on there? I guess it's on there. Maybe I just skipped right over it. Oh, I did. Here it is. Okay, German DAX. Channel resistance, as you can see, comes up right at the butterfly pattern completion point after you hit the 300 and 61% extension, which would be like somewhere right up here, which would be around 19,200. So looking for a counter trend short up at that level, but it has to reach or get very close to 19,200 for that setup, because it'll be counter trend, but it'll be very good risk reward. And that's what we want when we're trading. Great risk reward, counter trend. Last thing I need to mention to you guys is if you haven't checked out the trader funding program, we are starting to get some volatility in the markets. The FX is starting to get some volatility. Crypto's got major amount of volatility, which you can trade crypto. A lot of different cryptocurrencies in the trader funding program. Plus, you can trade around it in some of the indices too. So check out the trader funding program. If you're having a hard time getting capital to trade, see if passing one of our evaluations and getting allotted, a $50,000 account, a $250,000 account, $1 million account, something that fits your lifestyle and what you're trying to do. Also keep in mind, one of the best ways to get involved with Forex Analytics is getting in the trader funding program, because we automatically will let you in the community for a certain period of time based on what assessment that you take in the trader funding program. So check it out. It's a great program. It's a great option for a lot of traders out there. I know a lot of traders that are out there. I know a lot of traders that have passed. I know a lot of traders that have been paid out. So therefore, make sure you take advantage of these different things that are here for you, like the trader coaching, the trader funding program, and definitely Forex Analytics. If you haven't tried out Forex Analytics, it's only $1 for 10 days. All right, guys and gals, if you like this video, let's give it a thumbs up. It's free to do that. Also, jump down in the comment section below. Let us know what your thoughts are. If there's something that I missed this week that you think is very important, jump down in the comments below and let me know. And once again, all the moms out there, happy Mother's Day. Hey traders, this is Blake Morrow with Forex Analytics. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.